This is the third session of the Climate Finance Academy. My name is Ahmed Meher, and I am the Deputy Director of the Climate Finance Academy. Today's session is very special, and we have a new format and very distinguished speakers. Without any further ado, to save time for the session and our speakers, I'd like to give the floor to my colleague Bianca Anchites, who will be moderating today's session.
Wonderful. Thank you so much, Ahmed. And it's a pleasure to be here. We're really excited to have you. So welcome, Luth, Sydney, and Allan. And we're looking forward to some very rich discussions. I think I'll kick off by introducing you, Luth. Luth is the head of sustainability at ILX Management, and she's leading the sustainability team there and responsible for designing and implementing the sustainability strategy of the fund. And prior to joining this role, she's coordinated a portfolio of financial inclusion and impact investing at KIT's Unit of Sustainable Economic Development. She's advised the UN's Capital Investment Agency, and she's worked at the National Bank of Argentina as a financial advisor to the board of directors. So, a really interesting career, and looking forward to hearing some diverse insights from you. Next, we'll move on to Sydney, who's our second distinguished speaker. Sydney Straver is the founder and CEO of Bloom Sustainability, where she's dedicated to moving the needle on ESG. And prior to this, she's got a brilliant career assisting European firms in advancing their ESG agendas. So she's now bringing this expertise and best practices to the Pacific. And she's got a very unique approach of a strategic value creation lens, where she's helping investors and businesses seize opportunities where ESG meets creation. So, yeah, look forward to your contributions on the panel, and also sharing some insights from the Pacific. And finally, our last distinguished speaker is Dr. Allan Beltran, who's an assistant professor of environmental economics at the University of Birmingham. His research focuses on environmental valuation, the economics of climate change, and climate policy. And he's also had a brilliant career to date, spanning the London School of Economics, where he was a postdoctoral fellow in the Department of Geography and Environments. He's also worked at the Climate Change Unit at ECLAC at the UN, which is the Latin America organ of the UN, and at the Inter-American Development Bank. So it's a pleasure to have all of you here. And please feel free, I'll start shooting off into the first questions, but as you take the floor, if you'd like to add anything that I've missed from your bios, do feel free to just come in if there's anything specific you'd like to share from your experience with the group. And by way of very quick introduction, I'm Bianca Garvin. I'm a co-coordinator at the YOUNGO, within the YOUNGO Finance and Markets Working Group, along with my colleague Shitiz. So without further ado, let me move into a first question, and we'll start quite broad. And I'll give the mic to all panelists. But the question is, so private finance is often described as the missing piece in scaling climate action, especially that's something that we really hear a lot in the COP process and the negotiations, since we're mainly working a lot with parties there. So we keep hearing that private finance, that missing piece. So from your perspective, what's the one single biggest barrier that's keeping private capital from flowing into emerging markets at the scale required? And we'll just take it in order for now, in the order that I introduced you. So Luth, would you like to go first?
Surely, thanks. I will be brief in this question because I would definitely expand more when you then go with the next one. But I think it's really two things, right? What we see is really data, the need for more data, more transparent data, especially in private markets, within emerging markets. There's a lack of data that provides evidence to investors on why there's a huge gap between perceived risk and real risk. So data is one, and education is the second one. You need to really hold the hands of the institutional investors to demonstrate the feasibility of the asset class and the attractiveness, both from a risk return, but of course also from an impact perspective. As I said, I'll expand more in the next question. I think just thinking out loud, I mean, another relevant point as well is reputational risk. Oftentimes what we see in Europe is that there is an increasing list of excluded countries, and oftentimes institutional investors would simply exclude their exposure to some sovereigns due to reputational risk matters, basing themselves in indexes of the likes of the World Bank Group, accountability, rule of law, and of course, setting thresholds next to those. Oftentimes, that excludes exposure to sovereign bonds. But as well, we see that there are different parameters or definitions on how to gain or exclude exposure to private entities within those countries. And I guess that means that there is this reputational risk element as well, which also, I guess, requires data and education and holding hands as well to demonstrate what is feasible within these countries, and also how to help counterweight and counterbalance those aspects as well by supporting private sector entities within those countries. But let me stop there.
Thank you. That was really interesting, and also highlights the importance of these sort of international organizations in working towards the sort of data transparency and helping bridge those reputational risk gaps. Great. I'll hand on over to Sydney. Would you like me to repeat the question? I can very quickly just, the one, from your perspective, what's the one biggest barrier that's keeping private capital from flowing into emerging markets at the scale required?
Thanks, Bianca, and thanks also for the introduction. Pleasure to be here. I couldn't agree more with what Lou said. I think the capability building is also very essential. From my perspective, and that's very much the lens of working in Europe and then coming to the Pacific, is the biggest missing piece is really a common language, and a common language for what climate action looks like in emerging markets and how to go about it. And so a good example is, again, Europe. The European Union itself has the EU Sustainable Finance Taxonomy, which really helps investors classify what activities are sustainable or future-proof or more transitional, meaning that they're not really future-proof, but we need them in today's economy to transition to a sustainable state. And we've seen that in private markets that sustainable finance taxonomy has tremendously helped portfolio owners and portfolio managers really understand the state of their portfolio and how it's performing against key sustainability objectives like climate action or mitigation or adaptation. And so in emerging markets, these frameworks are still very much in development. We've seen that in Africa, we have the continent-wide sustainable finance taxonomy. I think India is close to publishing its climate finance taxonomy as well. And so we're working towards this similar framework in these markets too. But the only barrier is really that, unlike in Europe, these largely remain voluntary. And so these private market investors aren't really held accountable to showcase that, how they're performing on sustainability and what their, again, that common language is on what sustainability is in those emerging markets.
Great, thank you so much, Sydney. In that case, over to you, Allan. What's the single biggest barrier that you're seeing keeping private capital from flowing into emerging markets?
Yes, well, thank you very much first, YOUNGO, for the invitation. Thanks to Bianca and Shitis for hosting, sharing this panel with me. But I totally agree with what Luz and Sydney said, and perhaps to complement and to add to what they already said, what I think is an important barrier for climate finance is the fact that the incentives are not fully aligned. And when I'm talking about incentives, I mean incentives of people, incentives of government, incentives for firms, and incentives for investors, right? So, and unless we manage to align these incentives, the flow of climate finance would be very difficult. And let me elaborate on these 4 points that I already mentioned. So first, the incentives of people, which is basically the demand side. And perhaps I'm talking more from my economics perspective. You know, we care a lot about the market. So we need citizens and consumers to demand this this energy transition. We need citizens and consumers to favor the cleaner production of goods, and we also need them to reward those producers and those firms that engage with this corporate social responsibility. So we need an active society. So if people consistently reward these greener choices, then they create market signals for the firms, and remember what we want is alignment. So we need people that demand and reward corporate social responsibility. So that's, I guess, my first point on people. Now, I also talk about government, right? And we need a government that can translate this social pressure into effective regulation. And when I talk about regulation, and what we economists talk about is command and control regulation, which means specific technologies that are required for cleaner production. But we also mean market mechanisms, carbon taxes, emission trading schemes. That's one thing. Now, another thing we need from the government is strong institutions. We need the strong institutions to monitor compliance with environmental rules. We also need governments to fight corruption and crime and deliver macroeconomic stability. So we need a lot from governments because they actually set the rules under which all these actors interact. So they are a key element in aligning these incentives. Then I talk about firms, and when social and regulatory pressure, when these two are aligned, then cleaner production becomes in the best interest of firms, right? Then firms will engage on clean production techniques because it is profitable for them and it is in their best interest to do it. So if the market rewards low carbon goods and governments ensure fair enforcement, then firms have a financial incentive to invest in mitigation and cleaner technologies. And finally, which I think is more important, or the most important for this discussion, is aligning the incentives of investors, right? Which is the capital side. So once people and government shape a business environment that rewards cleaner production, then investors have the certainty that firms will deliver on their commitment. And this is also related to the point that Luz mentioned about having data, right? We need data that can show that the firms are committed and that the firms are delivering on what they promise. And in this case, investors will be more willing to allocate capital when they see stable rules, credible enforcement, and a market that rewards clean output. So if we align the incentives of people demanding clean goods, government enforcing clear rules, firms investing in cleaner production, and investors confident in returns, then private finance will flow to these markets, where it's currently not flowing.
Thank you so much. That was a very interesting perspective as well, in addition to the panel. And the three speakers have given us really complementary but also nuanced views. So let's move on to the next question then. And I think you've touched upon this quite a bit, talking about data quality, monitoring, but beyond just the mobilization aspects of finance, which it seems some of the, at least in our context, when we follow the UN negotiations, a lot of them is some of the discussions are very focused on we just need to mobilize finance, but we also need to ensure that what flows is of high quality and is also equitable. And this is more from a global level, but it's very applicable to private finance as well. So beyond this mobilization of finance, how do you ensure the quality and the equity of private finance flows? And how do you also ensure that the investments then reach the countries and especially the communities that are most in need, rather than necessarily concentrating in markets that are already attractive? So very interested to hear your perspectives, and I think I'll kick off just to mix it around a bit. I'll kick off with Sydney. Sorry to put you on the spot.
No, it sounds good. I might just build on what I just said around the taxonomy, and I think these are a very interesting tool to speak to that, right? So strengthening these taxonomies, that really ensures that financing reaches those who need it most. So here in New Zealand, for example, we're developing a taxonomy that's built on the Te Ao Māori view. So the Māori are our local Indigenous community, and we're building a sustainable finance taxonomy that integrates the Māori views. Similarly, the case here across the Tasman in Australia, they're building a taxonomy considering the First Nations views. And so what you're seeing is that these taxonomies are being developed and developing a common language for what sustainable investment looks like for those certain economies, for those certain markets, for the certain people, for the different communities. So really building on that, this co-creation of these taxonomies with governments involving civil society, Indigenous, First Nation communities, that really helps that these taxonomies are structured and legislated in a way that investments can trickle back down to communities. So that's one. I think zooming into the investor level, so how to strengthen that quality and equity of private finance flows. I think it's just strengthening your responsible investment policy, your responsible investment strategy, really rethinking, and in Europe, this is kind of, you don't really need to explain this anymore, but here in Australia and New Zealand, there's a lot of education to be done around what does best practice look like and how do we actually integrate climate and ESG and responsible investment into our responsible investment strategies. And so that means revamping your policy, revamping your due diligence, revamping how you practice active ownership, how you engage with your assets. So kind of building on that quality and equity aspect is really rethinking how can we build that lens into our own responsible investment processes. Because the reality is that a lot of governments haven't yet implemented things like taxonomies. And so investors are kind of held accountable themselves to rethink what they can do.
Super insightful. Thank you so much. Yeah, still mixing up a bit. Allan, do you want to go next and share some views?
Sure. Well, I will elaborate, I guess, on what I have already mentioned. I already mentioned that in order to mobilize finance, we need to align the incentives of people, government, firms, and investors, right? So in order to address this equity issue, I think we need to align this investment, but we need to understand and adapt to the various needs and constraints that developing countries face, right? So the key challenge is that in developing countries, it is much harder to align these incentives that I've talked about. So we need governments in these developed countries to implement the necessary policies, and we need the global north to support developing countries to achieve this objective. So again, I can elaborate on the different points talking about people, government, firms, and investors. First, if we think about people, so in many developing countries, people are not as active in demanding or rewarding cleaning production. And this is not because they don't want it. They want it and actually they need it. But the reason is because they face other more pressing needs that are all related to lower level of income. And these are needs which could be something like health, nutrition, housing, education, etc. So we need more development so that environment becomes one of these key priorities for people. So to strengthen people's role, we need development and income growth so that households can afford and reward these low carbon goods. Then when it comes to the government, and again, understanding the limitations that governments in low developing countries face, governments have the biggest challenge and the most important role, as I mentioned, because they set the rules of the game. And this has to be with the regulatory and institutional framework that provides certainty and supports clean energy transition, right? So governments need to fight corruption and crime and provide macroeconomic stability, which I already mentioned. And this is something that is particularly difficult in least developed countries because historically, they face macroeconomic crisis, they face issues of corruption, etc. So they need to control these issues in very challenging conditions. They also need to do more in terms of environmental regulations. For example, if we think about the countries that have implemented a carbon tax or that are implementing an emission trading schemes, most of these countries, except for some countries in Latin America and probably South Africa, most of these countries are in the global north, right? So we need policymakers, we need policy to do more in terms of regulation for reduction of greenhouse gas emissions in the south, right? Now, in terms of firms, and as I mentioned, firms respond to this social, political environment. And if the government creates the right environment, then money will flow. But also firms need to do more. And this is, again, related to the issue of data that was mentioned before. Firms have to be transparent with their finances and the technologies that they use. They need to comply with environmental regulations, and they need to be able to show in their books, in their finances, that the investments are being profitable, right? And again, once all these incentives are aligned, then investors are the ones that put the money in, right? But these flows of finance, they usually flow to developing countries as a debt that is expensive for developing countries, that come as high interest rates. And usually the problem is that this debt, they have to pay it in foreign currency, but they sell us goods in local currency, right? So this adds to the risk that firms have to face. And so what we need, I guess, is affordable finance, but also different type of finance. For example, we need investors also to invest in equity, not just provide funds in terms of debt, but also put their money, being shareholder of these companies that are leading the the energy transition in developing countries, so that they also share part of the risk of this investment and have their own incentives to make this transition successful. So yeah, that would be my opinion.
Thank you so much, and builds really well upon your earlier point as well about aligning incentives in a very concrete way. Great, and I'm already seeing questions coming up in the chat. Feel free to keep them coming, but we will hold off on the Q&A until the end of the panel section. So then I'm very excited to hear, Luth, what your thoughts are on how we can ensure the quality and equity of private finance flows, and that these investments can also reach the countries and communities that need them most.
Thank you, Bianca. Yeah, let me maybe underscore that last part of your question and our views there on really how to ensure that investments reach countries and communities most in need. And here I would like to start by saying that I think every source of capital has its own function. If we look at public finance, actually we see that adaptation, more than 90% of the adaptation solutions in emerging markets, but also globally, are financed by the public sector. If we look at the least developed countries within the emerging markets set, we also see that, of course, public finance has a huge role in those most risky countries. And of course, at the same time, I mean, I've been in Seville back in the summertime for the International Conference on Finance for Development, and it was very clear. Of course, the momentum is that we see, and the OECD has reported this recently, we are living in a low ODA environment. ODA, for those that are less familiar, being overseas development assistance. So public finance is scarce. We see that for next year or even this year, the prognosis is that it will drop in more than 9%. And that includes major developed markets dropping their ODA budget, which means that there's less cross-border flows from developed markets to the global south to finance these activities. So that, of course, then reinforces the need for the private sector to step in and really try and cover as much as possible of that space. And that's where we really feel the responsibility from a vision and mission perspective at ILX to try to do that in the best possible way. And how to do that in the best possible way? Well, of course, Sydney, you were referring to before having a common language, having taxonomies that are applicable per country differently. We definitely, I mean, I definitely support that. I guess coupled with what we see also being best practice also in the Netherlands, where we are based, is that asset owners, so institutional investors that are backing or funding our strategy, they also have impact mandates. And within these impact mandates, they are being more and more front-running the space in terms of understanding how to frame that impact mandate. And that means for our cornerstone investors that we need to report in line with the theory of change. So we need to have, of course, a defined theory of change. And as you actually see, so I come from the public sector as well. I work in the UN system. It's the same type of tooling that you would see being used in the public sector. And that, of course, comes with the responsibility of delivering the right outcome for the right pockets of underserved communities in these markets. That all being said, I also want to stress that I also feel responsible as the head of sustainability. We need to be careful to find the right balance, not to overburden managers in requiring reports that may serve an accountability and reporting purpose, but may not add tremendous value in terms of what actually that investment is achieving. So it's really that balancing act of being, I guess, as effective and efficient as possible in deploying capital where it's needed, and having reporting requirements. And I mentioned this because, of course, we do report against the EU taxonomy, and that's oftentimes, especially in emerging markets, very burdensome. And that's for several reasons, but amongst others, they do no significant harm checks, which is part of that taxonomy requirement, which means how do you prevent, of course, negative impact. It's very much EU-based, so it's very much leveraging EU legislation. So for you to demonstrate that if you invest in a renewable asset, you will be looking at circular economy, potential negative effects, you of course need to understand how those plants are being decommissioned. So to give an example, that could also be very much reliant on how the EU looks at those very specific aspects, and the same applies for other industries. So I think what I welcome is, of course, that broader, I guess, spread of taxonomies that are a bit more context specific and country specific. But again, balancing act, of course, we need to be wary of, there's a huge ESG retreat. We see some headwinds in the sustainability space. And much of that has to do with this reporting burden, with this sense of a lack of harmonization, lack of common understanding on common language, as was said before. So, of course, I think that we're still in the discovery process. I was yesterday, the day before, in an LMA conference, and I like what I've heard in terms of what we see a retreat, we see headwinds in sustainability, but actually what I think is happening is that we are recalibrating the space. It's really this moment of inflection where we also need to take our lessons learned on how to do this more effectively and efficiently. Still, of course, being very much cognizant of those accountability aspects, but also of those more practical efficiency aspects as well.
Thank you. I really like how you ended the notes on a moment of recalibration, and I think that's something we should all take with us. It's not just a retreat of the climate space, but a recalibration. Super interesting answer, and I also really like how you stressed this need for harmonization and separate standards without overburdening ourselves on just sort of inefficient constant reporting and processes. So really good points. I think
we'll now move on.
Yes, yeah, please do.
Sorry to interrupt, because I thought it was just such an interesting discussion, what Lou's just raised as well. And I think just what I've been kind of meaning to say just after hearing Allan and Lou's is just, if we go back to the quality, I think the key is also understanding the difference between sustainability and impact. I think that's a lot of, we talked about capability in the beginning, and especially what I'm seeing now working more in emerging markets across Asia Pacific is the need to educate and build capability on what sustainability means versus impact. We're seeing, especially in these markets that don't have, the government structures that support these kind of private finance flows, is that there's a lot of confusion about what these terms mean. So I think that capability, that common language is key first, also from that angle. Thanks.
Thank you, and a very important point. So we'd started off the panel really strongly with some great background setting and questions that you've all answered, and it's been very interesting to hear the different perspectives that all fit together, but provide added nuance to each other. But we'll now move on to very more sort of panelist specific questions that you can all dive into expertise. And for the first one, I will stay with you, Luth. ILEX has pioneered mobilizing institutional investors into innovative co-finance structures for emerging markets. So could you briefly explain this strategy? Sorry, I noticed I'm breaking up. So can you still hear me okay?
We can hear you, yes.
Yes, great. I'll just switch off my camera to just so I can ask the question without breaking up. But yes, so could you briefly just explain your innovative co-financing strategy? And then what lessons have you learned about aligning investor risk return expectations with climate and development goals?
Surely. So indeed, let me start by explaining what we do. So basically, we are an asset manager based in Amsterdam. As I said before, we are managing what we call private debt, but it's essentially co-investing pari passu, so in the same terms and conditions than multilateral development banks and European development finance institutions of the likes of IFC, being the private arm of the World Bank Group, the Inter-American Development Bank, institutions based in Washington, but also in London. We have the European Bank of Reconstruction and Development. We have the regional banks, being the African Development Bank and the Asian Development Bank, and also what we call bilateral DFIs or European DFIs, which are the likes of FMO here in the Netherlands, but also BII in the UK, Proparco in France, DG in Germany. So what we do is we partner with all these EDFIs or MDBs to invest in emerging markets and invest in emerging markets at scale. And we represent institutional investor capital. So we represent capital from pension funds mainly. Started really anchored in the Netherlands, and then we did branch out to the Nordic countries. So our first fund, so I'm with the company since the inception phase. So back in 2018, we really incubated the concept and the idea of how do we bring together these two different universes? How do we link and educate and communicate with institutional investors on the one hand, with their own views on impact and what that means, and of course, on the other hand, the EDFIs, the MDBs. How do we make them speak the same language, but also how do we demonstrate, more importantly, the benefits of investing in this asset class also from a risk return perspective? So back in 2018, we were backed by the public sector, and indeed the international development arms of different nations, including the Dutch, the German, and the British. So the FCDOs or ex-FCDOs of this world, incubated by them, and then launching our first fund back in 2022. Our first fund invested purely by Dutch pension funds of reaching $1 billion USDs, and then we did a top up of that fund last year, and we closed a second fund with Danish investors. All in all, we reached very large scale in a short amount of time because we are currently managing 1.7 billion USDs on behalf of pension funds and deploying that capital in emerging markets. We are very happy to say that in 3.5 years, we reached 65 projects in almost 30 countries in emerging markets. And that's only possible, of course, because we leverage the capacities, the knowledge, the expertise of the multilateral development banks and the European DFIs. And we did this across different sectors and different regions, but mainly, I guess, to highlight a few, we invest a lot in renewable energy. We invest a lot in agri projects, in food security projects, but also we partner with, through the MDBs, we partner with financial institutions, those being mostly regulated commercial banks, that really enable us to reach those underserved segments. So through them, we're able to serve also smaller projects because, of course, the local banks are the ones that have those clients that we cannot directly reach because we do larger ticket sizes. And that means that if we would invest through an MDB in a financial institution, that will be with a very well-defined use of proceeds clause or basically earmark financing, which means that we will, in the loan agreement, need to see the eligibility criteria, and the bank would only be able to on-lend that facility to a specific segment, typically being small and medium enterprises, green projects, mostly renewables or energy efficiency, and also we've seen some low-income household benefits as well, and women entrepreneurs. So that's, I guess, in a nutshell, or a big shell, as a colleague of mine likes to say. What we do and how we do it is we are a team of 25 people based in Amsterdam, of course, with our different functions and roles. Sustainability, we are 3 within the investment team, fully integrated, but really appraising every single investment on the impact characteristics, but also on this do no significant harm, if you may, but it's what is the potential environmental, social, or corporate governance risk, mostly linked to greenfield new projects. You can think about wind, you can think about solar, of course, all being very beneficial for climate objectives, but there are also social risks that could come next to those. So we look at that in every case, and we ensure that the mitigants that are put in place by our partner MDBs are in line with the expectations of our borrowers as well, of our fund participants as well. But let me stop there with who we are. Being cognizant of time, let me go to your other part of the question, which is which are the lessons learned about aligning risk-return expectations with development and climate objectives or goals. I think there we basically, in terms of lessons learned, we always have a very clear definition of how do we see impact investment, or to your point, Sydney, before, would that be different from sustainability or not? We've always been very clear, we deliver impact, and we can do that by partnering with the MDBs and DFIs, and we can account for that and measure that, given the data that we get through them and the data that we model ourselves. But we do not see that there would be a trade-off between delivering impact and having an attractive risk-return asset class. So for us, what is very important is to demonstrate that they need to go hand in hand. It's not one at the expense of the other. So drawing on the GEMS database, which is a global emerging market database, is a huge database populated with default and recovery statistics from more than 26 multilateral development banks over 3 decades. So there's data on default in emerging markets of private sector entities. There's data on recovery, always operating under the umbrella of the multilateral development bank system, or EDFI, of course. There's more than 2,000 default events in that data set, and more than, I think, something like 15,000 loans as well in there. So that means that it's a rich database statistically. It's the long trend. It has a lot of data points in it, and it's very rich with what I was saying before, when we look at the environment in which we operate, which is really a data poor environment in private sector, in emerging markets. There's not tons of data, or not tons of data providers. So we found it very, of course, relevant, and that's the work that my colleagues have done throughout the years to really demonstrate how, in the long run, the basically loss given default of the asset class is in line with comparables in the emerging market space. Emerging market credit profiles that are similar to that could be leveraged loans, high yield bonds, corporate emerging market bonds, or SEMBI. What we see is that the default rates are in line, but the recovery rates of the MDBs are much higher, almost double in many cases. And why is that? That's because basically the DNA of the MDBs. The DNA of the MDBs is not to sell down a position whenever the borrower is in trouble. It's, of course, it's not a liquid, it's a buy and hold asset class. The mandate of the MDB is to really work together with the borrower to make them go back into a healthy state. And that's possible because, of course, not only because ex ante they have very conservative loan structures, very rigorous credit due diligence, and also ESG due diligence. But of course, it has huge dedicated restructuring teams, and of course, in-house legal expertise, sector and country expertise, I should say. So they have a cradle of sector experts also on ES. If we, for instance, invested in a mining lithium mining project in Argentina. And what you see there is that there was a cradle of hydrologists going to the site, really spending a lot of time with the project to understand what would be potential negative effects and how to best mitigate those in terms of water availability and other relevant points. So I think basically what's important for us, just to recap and reflect, is to demonstrate that the asset class is not only having low credit losses in the end, because it's basically an at par default, it's a recovery rate that is higher than comparables, which means that we have lower credit losses than comparable asset classes. But it's also that together with the fact that the MDVs their pricing is market-based, and it's a very stable pricing. So stable pricing throughout the cycles, it's very important for investors to understand that in times of economic downturns, and we are seeing that now, not only sustainability is facing headwinds, developed markets are facing headwinds. They're grappling with volatility, they're grappling with political instability, and they're also facing tight credit spreads. At times where we see cyclicality, that's, if you see the long-term analysis, that's really where our asset class, or the asset class of development finance, really stands out, because it's a stable asset class and it offers not only attractive return, but it's really this risk-adjusted return concept and stability concept. It's a through the cycle asset class, which is important to offer diversification effects in the portfolios of institutional investors. So all of that is what we've been able to demonstrate by tapping into the database of GEMS early on in the early days, and to really, quote unquote, educate the markets of institutional investors, being, of course, not even aware of what a DFI or an MDV acronym stands for. So very happy, very proud, of course, of having been part of this project since inception, and being now part of a growing team with a growing real portfolio behind. And with that, I'm sure I'm out of whatever time you assigned to us. But
No, thank you so much. And thank you for really going into detail and giving us a bit more of a technical understanding of the innovative tools that are available. We are splitting the moderating, so I'll hand over to my co-moderator, Shitters, to take us through the next panelist question. And thank you so much.
Thank you, Bianca. And Luz, I really loved whatever you said. All the nutshells and the big shells that you spoke about really do make sense. And I love how you spoke about capacity and information, because that sometimes often gets lost in the conversation. And building on capacity, my next question is to Sydney. Sydney, many small and mid-sized firms often struggle to access sustainable finance due to capacities. In your experience, what innovative models have you seen that have successfully extended this ESG aligned finance beyond these large corporations which have big teams, big capacities, and big funds to channel through this sustainable finance? So would love to hear your thoughts on this.
A really good question, and I can spend a full day talking about that because that's my bread and butter. But I'm going to start with kind of the role of SMEs, because I think it's important to address that before I get to your questions. And so the role of the SME, if you want to get access to financing, you need to kind of look in the mirror first. And with that means, positioning yourself as a way, that you're attractive to potential investors. The first key thing for any SME to do, and you don't need to have a big budget for this, is to understand what are your key ESG related impacts, risks, and opportunities, and translate these into data-driven insights so that these can inform your business strategy, right? So for one company, that might be energy and climate and health and safety, but for another company, that might be product lifecycle and ethics and compliance, really depending on the industry they're operating in, but more specifically the value chain activities and the likes of that. So first step there is to make sure that the SME has a framework for what sustainability means in their business context to make them more attractive to investors. For those of you who don't know, that whole analysis is called a double materiality assessment. We also consider that impact lens. So feel free to do some research in your own time, and might share some links in the chat in the next couple of minutes. But showcasing investors that you understand your impacts, risks, and opportunities through that double materiality assessment really positions you as a lot better. It showcases that you understand what you need to do to make your business future-proof, to make your business resilient, right? And you have a more holistic framework of what, you know, your operational, social, and environmental needs and risks and opportunities are. So once that foundation is in place and you've got that framework that positions you for that, there's several kind of innovative financing models that we're seeing with our clients kind of across the globe. I think the one that's particularly kind of prominent when I was working, Luce, I was also actually in Amsterdam at the time, is sustainability linked loans were quite a big topic for companies that couldn't get access to either private kind of venture capital or private equity or private debt funding. And so what we see is sustainability linked loans from banks. What that means is that banks want you to prove that you have strong ESG credentials so that they can offer you a loan at a lower interest rate, right? So in that way, kind of going back to Allan's point on incentivization, they incentivize SMEs to embed sustainability in their operations. So that's one. I think the second thing, obviously impact focused investment funds, right? Which is difficult to target because you really need to showcase venture or growth funds that, again, you have strong ESG performance, you understand your impact, you understand either your positive impact or how you're reducing negative impacts, and you have strong data to back that. We see that investors are increasingly looking for that proof of impact through frameworks. So there's one framework called the IRIS Plus framework that's widely being adopted to showcase proof of kind of measurement. And the other one is the Impact Management Project, which is much more qualitative framework, but it just helps organizations, SMEs, clarify what impact is in their different business activities, right? So that's the second one. And then the third one is a little bit more emerging, and we see this kind of, again, mostly in Europe and parts of Asia, but it's supply chain linked finance. And it's where kind of the larger corporates, the larger end of town, rewards the smaller suppliers for their sustainability initiatives as well. So with preferred financing or improved payment terms, because they've, again, kind of embedded ESG in the way they do work and have strong credentials. So there's various approaches, and I can talk about a lot more, but these, I think, are the ones I'm seeing most in the work that we do. And yeah, just again, kind of wrapping it up with the key for SMEs to kind of look in the mirror first and think about, if I want to gain access to that funding, how am I going to do it and what will they be looking for? It's that understanding of those impacts, risks, and opportunities.
That's amazing. Thank you for concising all of this depth of information that you've just shared with us. And I totally agree. I mean, even back in India, the small and medium-sized firms, it sometimes gets lost in translation that even the big firms that are mandated to follow the ESG compliance, almost all of these medium and small size firms are part of the supply chain. So once that big firm has to decarbonize the supply chain, they have to get on board. So, I mean, great insights. I'll now get to the next question, and which is for Allan. Allan, your research shows how the economic impacts of disasters and risks like flood capitalization directly shape investor behavior. And you've spoken about incentives, but why do you think understanding these risks is essential to scaling private climate finance?
Yes, well, I think that once we understand the dimensions of the risk related to climate change, and by the dimension of the risk, I mean the magnitude of sea level rise, the extent to which drought, floods, or forest fires will affect the economy in the future. Once we understand this, then we understand the urgency to act, right? So we need to understand what we are facing in order to trigger action. And once we have this clear, then we also can have an idea of the amount of investment that is needed to prevent those impacts. So, and I guess coming again to the topic of aligning interests, now I'm going to talk a little bit more of aligning the interests of the North with the interests of the South, right? And I guess the issue that we usually hear is that the issue of climate change that comes from greenhouse gas emissions is that greenhouse gas emissions are global, right? So it doesn't matter where they are emitted.
Is it only me, or is the voice actually breaking?
It is breaking. I thought it was me, but I got the same.
They all contribute to global green. Hello, can you hear me?
Yeah, we can hear you now.
Sorry, I
It's
guess,
perfect.
is that my internet? So,
I
sorry, I
think
hope my internet will be okay for the rest. So I was talking about that the key point is that, you know, greenhouse gas emissions are global, but the impacts are local. And in this means that they affect people, businesses, investors, etc., wherever they are, regardless of whether they are in a developing or a developed country, right? So if climate change and the risk of climate change will also impact people and businesses in the north, then that means that it's also in their best interest to reduce greenhouse gas emissions, but not only their greenhouse gas emissions, but also the greenhouse gas emissions from the south. You know, so once we understand the risk of climate change, then we understand the amount of action that we need, the amount of money that we need, and it really, it's when you talk about our duty to prevent climate change and to stop greenhouse gas emissions to an economic necessity, like the need to invest money to prevent any where the mouth is.
Right. Makes sense. I mean, what I'm hearing from this is that there is an economic case for you to act on this, and this is not just limited to your own boundaries, but it is global. So you have to basically act on what cost it will come attached with your operations. Right. So we have spoken about what different problems exist, and now I think it's best we move on to solutions. So we have one last question to ask all the panelists. Looking ahead, what's one innovation or shift, whether financial, political, or technological, that you think will reshape private climate finance in the next 5 to 10 years? And we can start with Sydney.
I'm gonna have two if that's okay. It's hard to
It's
pick
all right.
one, but obviously the big AI, huge potential in various aspects. So I briefly just talked about the SME kind of side over there. Great, that will help us better understand the data issues, benchmark things, again, facilitate that common language through kind of automation and everything around that. So I'm very keen to see how that's going to materialize, and hopefully better understand climate risks, scenarios, opportunities, because that's kind of goes into my second point, capability building, I think is so much needed, right? So it's been a key trend, I think, in all our conversations is we're really talking about a new lens for investing. This whole climate ESG aligned finance is kind of emerging as we speak. And that's why we also have those challenges, right? So that whole conversation about ESG being dead, taxonomy is kind of emerging at different parts of the globe with all of kind of a similar language, but at the same time, a very different language. So that capability building is much needed. And we see that especially kind of zooming into the investor side of things. We work a lot with private equity, private debt, venture capital, and what we see there is that's often one person handling kind of the ESG stuff, which is great, but then, you know, the rest of the investment team is just doing business as usual. And so who are we kidding, right? Like we've got a nice responsible investment strategy lined up, which really glossy writes out how we're going to, you know, have a positive influence on society and the environment, but in reality, it's one person juggling all these things. We really need to build those capabilities across kind of investment teams, make sure everyone's engaging with, you know, the private active ownership model that we try to encourage, which means engaging with all the companies that you invest in and making sure that they also uphold themselves to bare minimums on sustainability and climate action, and in that way you accelerate change. I might also be a little bit cheeky, and we actually do a 5-week upskilling course on kind of ESG strategy as well, because coming from my background in Europe and then back here to the Pacific, and I've alluded to this a little bit earlier, I was quite shocked at the state of the market here, and there's such a need for that capability building. Over here, when I talk to investors, I'm still explaining what ESG stands for, and you know what even a taxonomy is to head of sustainability here in New Zealand. And that capability building is just so much needed, especially with the new generation coming into the workforce. So I encourage all the YOUNGO stars here today to also think about what they can do themselves to upskill. And I'll share it now in the chat.
Wonderful. That's really amazing. Now we can go on to Luz.
Thank you. I mean, being very brief here, I think basically politically we are seeing huge shifts. Of course, geopolitical shifts. We are seeing a different era in terms of multilateralism and where this is all heading is still unclear, of course. But I think what we have hopes on is that the multilateral development bank system is still firm and is still actually delivering on its function, which is really to have these cross-border capital flows reaching emerging markets, not only for climate, but also for social solutions. And we see that, of course, there's a big push for them to even triple or even quadruple the volume and the amount of loans that they do, and to really bring in the private sector much more to co-invest with them so that they could themselves penetrate those smaller niches or those countries with lower income as well. So I guess the hope is that, of course, there's a continued push and a continued scale up in that function of the MDB system, so that we keep in a cohesive multilateral geopolitical as well frame.
Thank you, Luz. Now we'll go on to the last panelist, Allan.
Yes, well, I think I will perhaps go around what Luz just mentioned about the political shifts, right? Because I've spoken about how important the role of the government is to bring a positive change, and to trigger this or unlocking. But also, when I think about this, these political shifts are not necessarily in a positive way, and I guess this is something of what we are seeing now globally. So, if the desires and beliefs of people are no longer aligned with those of the government, and this happens especially in these countries that are leading the energy transition, then the whole landscape of climate finance might look very, very different in the future, because it's actually this alignment between people and government that triggers alignment with government firms and investors, right? So this is important. And, we're talking about these political shifts. I'm thinking more precisely about the case of the US, So if there is a government that denies climate change and removes foreign support and finance for climate action, then that has implications for climate finance. And of course, Trump might have his own views and his own ideology, but this wouldn't be a political campaign if there were not people supporting these views and following this speech, right? So in this case now, the priorities of the government do not longer go towards the environment and towards reducing greenhouse gas emissions. They are in line with half of the population, which also means that the priorities of half of the population are not aligned with the priorities of the other half of the population, right? So when all these alignment start breaking up, then you have an issue, because finance is no longer gonna flow, right? And we're already seeing these policy changes that affect climate finance, because we've seen the US withdrawing finance and support for reducing greenhouse gas emissions, etc. And more recently, and I guess the issue is that this kind of ideology and this kind of speech, they spread, right? And most recently, we saw Trump at the UN Assembly talking about how immigrations and these suicidal energy ideas will be the end of Western Europe. Right now, the problem is that if people listen to this, if governments listen to this, then you have another very important part of these countries leading the climate transition, then moving into these areas where it might also change the political landscape. And we know that in Europe, there is also instability around these areas. So if leading economies, so they turn away from climate action, then the space for private climate finance could shrink very quickly.
Definitely, and very interesting what all you said. And I think it's a day-long conversation in itself, the topic that we just discussed. And I love the fact that you were so optimistic, all of you, about what should happen in the next 5 to 10 years, given the current geopolitical space where we don't know what will happen the next day. And all of what you said really makes sense. And now I think this was all like a masterclass for all of us, all the people who joined the academy, and I'm sure we have a lot to take back from this. We'll now open for Q&As. If all of you have a question, please do raise your hand. And while asking the question, keep it brief and also mention that who do you want it to answer, or whether it's open for all, you can mention even that. So you can raise your hand or type your message in the chat, whatever you're comfortable in. Come on, don't be shy, guys. I know you have a lot of questions. But until then, I'll open the chat. I think we had a question in the initial part of the conversation. So it's to Sydney. Liam says, "Hi, Sydney. Very interesting about New Zealand's sustainable finance taxonomy. This might be a very specific question, but regarding New Zealand's taxonomy in its development, was the criteria developed in line with and used components from such as taxonomy approach, list of activities, sectors, other countries' taxonomy such as EU, ASEAN, Ireland, Singapore, etc., or maybe more importantly, what is unique about New Zealand's taxonomy? Another question also, what challenges have been faced in its implementation and use? Over to you, Sydney.
Really great question. So obviously New Zealand hasn't reinvented the wheel. Thank goodness it hasn't. It did the case. Just a fun note on New Zealand was actually the first country to adopt climate-related mandatory reporting. And for those of you who might know, that was a complete disaster. We had a lot of issues with kind of large financial institutions struggling to go about that, because being the first nation to implement mandatory climate reporting and having no global benchmark, it was extremely tricky for many investors here, and especially being such a small nation. Anyway, to go back to the New Zealand Sustainable Finance Taxonomy, I think they had a learning and thought, hey, let's not be the first ones doing this. And so the whole taxonomy has indeed been built on kind of, you know, many taxonomies, the EU one, the Australian one. So commonalities include kind of that triple criteria, right? So the do no significant harm, those kind of things. And so good to know that in the development of taxonomies, what these bodies like to keep in mind is this concept of interoperability, right? So you might have investors that are operating multiple markets. Just make sure that there's some way that it can be interoperable and kind of aligns with global standards. So definitely not didn't reinvent the wheel, but what is unique is that, again, I mentioned earlier, it has some distinctive features, and specifically including that Indigenous mindset, right? So in New Zealand, the Indigenous community, as mentioned earlier, is the Māori. The Māori is actually structured a little bit interesting. So we have what we call iwi, and they're kind of like governing bodies as well. And what New Zealand has done in the development of its taxonomy is that it's closely worked with what we call these iwi, which are, there's multiple groups of them. They're kind of like governments, if you will, and collaborated with these different iwi groups and integrated their mindset really into the development of that taxonomy. And what that means and how that makes the taxonomy unique is that there's really specific recognition of the cultural heritage of these Māori. And what I love so much about the Māori view is that it really takes a holistic view of our world, right? So it considers the people, the nature, the planet, everything holistically, which is a beautiful concept if we trace that back to sustainability and kind of climate finance as well. The key challenges, which I think was the second or third question, has been the implementation, right? So it's still in the draft phase. So these taxonomies get developed, and then there's stakeholder consultations, there's technical advisory groups, different people get included to develop and make sure the taxonomy actually makes sense. And so as part of that, you can imagine investors get involved, NGOs, businesses, responses from kind of leading industries. So there still is quite a development around that. But the challenge has been, because it's still voluntary at this stage, and it's looking like it will at least be for the next couple of months, if not years, is that there's really little talk, especially for private market investors who have no clue about what a taxonomy is. And so that kind of goes back to why I'm so interested to see the shift in education and capability building to make sure investors understand that. Was that the answer to the question? What do you think, Shadiz?
I think it was very well answered. I think if Liam can answer on that, that would be great. And I think his question was very famous as well. We had a reply on this question asking that what are the concrete ways that the needs and the concerns of First Nations people are incorporated into the taxonomy. So if you have anything to shed light on that as well, please feel free. This was asked by Marco Muzenda.
Yeah, so like I said, just kind of considering their cultural heritage, right? So with all these Indigenous groups, they have very strong cultural heritage, which are beautiful, and they're really taken through these public consultations, through these technical advisory groups, very strongly included in the development of what classifies as a sustainable activity. So what that looks like is, the way that Māori sees environmental risks might be very different than the traditional kind of Western European view in New Zealand. So for those of you who don't know, New Zealand has like New Zealand Europeans who are kind of like the New Zealanders, but then we have the Māori. And so that's kind of how we work here. But it's really about combining these two views and kind of, yeah, like I said, done through that broad stakeholder consultation in various ways.
Thank you so much, Sydney. We have our next question from Vidhi. I think it's open to the panel, so whoever would like to take this question. Vidhi says that we all know that loss and damage is critical and trillions have been promised at the global level. But what I'd like to understand is, where do private companies fit into this picture? Should their role be seen as co-investors helping to mobilize capital, or as accountable actors who must directly contribute to the fund? Any of you can take this question.
Well, perhaps I can start, but I would just say very briefly that I think we need to think about firms as both, right? We need to think about them as co-investors in helping mobilize capital, and also as accountable actors. Because the person who wrote this question, sorry, it's BD, it's totally right. They need trillions, and actually the figure that is now, because they like these figures, it's 1.2 trillion dollars that we need in order to tackle climate change. So and that would not be achieved unless private capital flows. So in that sense, firms and businesses and policy has been part of the issue in terms of using fossil fuels and contributing to greenhouse gas emissions, but they have to be part of the solution, and we need to find the ways to bring firms on this challenge of tackling climate change and reducing greenhouse gas emissions, because otherwise it's not going to be possible. Government funds and policy is not enough to achieve the objectives.
So to complement, maybe jumping in here, I guess it's just to qualify as well the 1.3 trillion new figure that we are hearing about in the new COP. I guess it's really in the roadmap from Baku to Belém. And Baku, there was this NCQG price tag of 300 billion USDs to flow into emerging markets, mainly from the private sector and multilateral development bank system. And I think what we see now is that ambition of scaling that further and adding $1 billion next to the 300 stated before, to really define and shape the role of the private sector. That's different to loss and damage. Loss and damage has been, I think, back in Egypt, established as a fund, and back in, I guess, in Dubai in the COP28, there was also a price tag assigned to that and a bit more action behind, but it's really focused on adaptation. It's really loss and damage focused. So there, the role of the private sector, I think there's less scope than for the general mitigation objectives. Again, if we look at the statistics, I think over 90% of the financial flows in the adaptation space come from the public sector. And that's because the type and the nature of activities that we are currently understanding as adaptation are somehow related to the mandate of the public sector. That being said, I think there's more and more development of different understandings on adaptation, especially in the infra space. And I think really building resilient infrastructure and understanding how to do that and how to embed in every project, in every greenfield project, this adaptation lens is something that I think we're seeing a bit of a growing space there. So there I see more of a role for the private sector when it comes more clear what do we mean with adaptation, in which spaces can we use that, and in which spaces it makes sense that the private sector steps in, because of course you need to guarantee public services as well and couple them with private financial flows.
Right. Thank you. Thank you so much, Luz. Do we have some other questions?
I might just
think-
add to that in the meantime, if that's okay.
Yeah, please do.
I think, just kind of building on that again, I think, again, speaking from the investor lens, from the private market investor lens, I think there's really that need for active ownership, right? So adaptation and mitigation is extremely context specific, and it's really up to the investor to engage with the companies in their portfolio to realize that context specificness, help companies understand what, climate adaptation and mitigation looks like in their specific scenario. So I'd also like to just emphasize that role of the investor in helping companies realize how to future-proof from that angle too.
Right. So I think we don't have any further questions. I think you all were so clear to all of them. They're left with
Sorry.
no doubts about the subject.
Sorry, I just wanted to ask a question, perhaps, if I can, to Luz and Sydney, and it's related to the issue of greenwashing. Of greenwashing from both perspectives. The finance and the mobilizing funds and the data we need, etc. But also from the business perspective. Sydney is part of the business, so I'm sure it's a challenge that they face. So I just want to know what you think is the issue, the extent of the issue of greenwashing, and what can we do about it?
Okay. I think it goes back to that. So I briefly mentioned kind of the lack of understanding of sustainability versus impact. So what I'm seeing in the market is a lot of investors, but also businesses claiming that they have impact reports or using the Sustainable Development Goals as an excuse to, we like to call that rainbow washing, just put them on their website and say we contribute to SDG 4 and SDG 13, but then don't have any credentials to back that. And I think especially in private markets, that's especially in markets where there's limited legislation that mandates certain disclosure requirements or certain standards that need to be upheld. There's a lot of confusion around that. And fortunately, I think on kind of the business side of things, there's been some unification towards kind of sustainability reporting, which is good. So the IFRS has taken ownership of unifying sustainability disclosures, which has been phenomenal. And we're seeing, especially here in Australia, much more clarity on kind of what to report, how to report it, what you can report, what you can't report. So again, the role of legislation has been phenomenal from the business lens, and I'll let Luz speak to the investor side of things.
Yeah, and I think, of course, I guess greenwashing means different things for different jurisdictions. Of course, in the US, we see a complete different and reverse move. But also in Europe, what I see is a lot of green hashing as well, which is exactly the opposite, right? It's really asset managers and asset owners not disclosing articles in terms of specific legislation of SFDR, Sustainable Finance Disclosure Regulation, that are ambitious because of the reporting burden or because of the legal risk that comes with that. So again, striking that balance between not, of course, painting a rainbow of SDGs or a Christmas tree and not backing that up with data and not reporting back and have accountability mechanisms that are strong enough. But then again, and we've seen a lot of the net zero alliances shutting down some of their functions because their accountability functions have been put under stress. Of course, after the US wave that we've seen in terms of ESG retreat that has had big effects. So there were good and solid accountability mechanisms, but then again, how do you strike a balance to keep them alive and to keep them, basically being able to deploy and deliver on their functions. So I think we need to be careful again in striking the right balance between greenwashing and greenwashing, and how do we do that effectively and efficiently, a bit to my previous point earlier today.
Allan, what's your opinion though? I'm curious to hear from your lens too.
From academia. Well, I mean, from the mobilizing finance, etc. Why I see as a challenge is the problem that, investors need certainty that their money is put into businesses that are actually delivering what they promise. So I guess there's a problem with data, with information asymmetry, but it's also a problem of policy in terms of, making regulations so that firms can comply with environmental regulations and that they are transparent in what they report. That's on the policy finance thing, and for a very broad perspective, because I'm not really in the finance area. But from the business perspective, and it was very interesting because I've never heard this view from what it means from someone that is part of a business and that actually is part of sustainable businesses. So I guess it was very interesting to hear your view on this, because you face this every day, right?
Amazing. So I think we have one last question, and it's again from Liam, and it's posed to Luz. He says that you mentioned corruption in terms of mobilizing or countries receiving green finance, be it from public or private sources. What are the typical challenges and also the mitigants to prevent corruption? Is this unique to green finance or not? Does it just depend on national compliance, regulatory capacity, or can global standards or support, say, from international development partners help to address corruption relating to green finance? It's a heavily loaded question, so it depends on you on how you want to answer this.
So I did not mention corruption, just to state that very clearly. Maybe that was misheard. I'm trying to think what was that I said that linked to that question. No, that's fine. But I guess I did mention reputational risk very much at the beginning of the discussion. And I think in that sense, what is very important in every investment process is to have a very rigorous view on those different triggers of reputational risk that could be associated with investments, which have to do potentially with ABC matters, so anti-bribery and corruption, potentially with environmental, social, or corporate governance concerns. So for us, what is very important is, on the one hand, of course, we have the partners that work with us, the multilateral development banks, that do a full appraisal on ESG risks, and not only an appraisal to understand and identify those risks, but really working together with that company to make them improve their ESG behavior. And that's not only a commitment that is linked to a benefit in the pricing as a sustainability linked loan structure. It's really embedded in the DNA of the MDB system. Every time that they operate with a new or an existing company, they will do a full ESG screening, which entails oftentimes going on site and doing a full visit to understand also affectation to local communities, to your point, Sydney, before, initiating those communities, and having, of course, stakeholder mechanisms and consultations in place. And basically, if there is a risk identified, linked to whatever trigger, there is an action plan put in place. And that action plan is time bound, so it has teeth, because it's also embedded in the loan agreement. So there is, of course, a lot of leverage, because would there be a deviation of that commitment, then a remediation or a mitigant needs to be put in place to go back into a compliance with that commitment. And it acts the same way, and it has the same leverage and enforcement power than any other covenant in the loan agreement. Would that be a financial ratio or any other financial covenant? So it's very, very powerful and gives us a lot of comfort. But on top of that, we do for every investment, again, a full appraisal with our view, acting a bit as a second filter, second pair of eyes, and really calibrating the risk appetite of an MDB with that of our investors, which is not always on a one-on-one. Of course, it's mostly very well already secured, but we have that additional layer, an additional role to really bring it next to their impact, but also reputational risk appetite. I hope that answers your question. I did not mention corruption, but I think it covers the point.
Thank you, Luz. And corruption in green finance is again another topic to talk about. But thank you for joining us today, all the panelists and the people engaged in the academy. We hope this conversation gave you something to think about and act on. Until next time, I think you stay curious. And one good thing is that even if you heard corruption, you were still curious about it. So that's one good thing. And stay engaged with the course ahead. I'll now hand over to Ahmed. And thank you again to all the panelists for sharing your insights with us.
Thank you so much to Louis, Sydney, and Alan for being with us today and for sharing such valuable insights. I really enjoyed that conversation, and I hope that we can have more time to discuss the topic further and link it with all the thematic areas of the UNFCCC, including Article 2.1c, Article 6, NCQG, and the Equitable Lab. But unfortunately, we came to the end of our session, but we are looking forward to have more opportunities to engage together, engage our network with you and your institutions. And thanks to Bianca and Chitis for moderating the panel. On behalf of YOUNGO and the Climate Finance Academy, we are grateful for the time and the thoughts that brought to this conversation. Before we wrap up, there is a couple of reminders to our participants. Please don't forget to fill out the attendance form that was sent in the chat, and it will be your way to count your presence today. By the end of next week, we will be sending an email with all the details for the final project of the Academy, including your teams. And that is when the collaborative part of the Academy will really kick. And so stay tuned. And finally, thank you all for all the questions, the comments, and the energy that was brought to the session. It was very good to have this in our space and make it alive and meaningful. Looking forward to see you at the next session. Until then, big thanks to all our panelists once again, and for you all for being here and being part of this journey. Thank you.
Thank you,
Thanks.
everyone. Bye-bye.
Thank you, everyone. Bye-bye.
Thank you.
Thank you. Bye.